together here and talk about different option strategies that might be appropriate for the current market conditions that we're in. Now, some of you have, through surveys and questions that you put out in the chat, have expressed some concern about, what is the right strike price to maybe focus on for a particular strategy? And how do you know what one is the best for you? Now, what could be best for you might not be best for somebody else. But by the time we're finished here today, what I hope that you walk away with is that you have a clear idea of what you personally feel comfortable with, so you know how to target and approach the different strategies that we're going to talk about today. Hopefully that will make sense here in just a moment. Now, I am joined in the chat by Cameron May. Cameron, good to see you here. I know he's been on back-to-back chats here. But Cameron's here to help answer any questions maybe I can't quite get to, or maybe they're a little bit off topic, although I hope that you keep most of your comments on topic here today. But when you have those questions, chat them in because we want to get those addressed for you. Now, many of you are listening to this only on the archive. And for those of you that do that, when you have questions, put your questions in the comments section in YouTube. So I go back and look at those throughout the day and make sure that you get your questions answered quickly as well. Hope you're following us on X. I'm Connie Hill CS. Cameron May is Cameron May CS, and we'll both post educational content. Sometimes we'll post some charts, what we're noticing about the chart, what might be going on, and maybe pose a question to you that gets you thinking. So follow us. It's free and easy to do. Let's go through our disclosures and let's lay out our agenda here. Options carry a high level of risk and are not suitable for all investors. What we talk about today is intended for education and information. Don't consider it a recommendation. We will be using the Paper Money software application. That is what you download to your computer. It's the most robust version of Thinkorswim. Investing involves risk, including the loss of principal. With long options, investors may lose 100% of their funds invested. Past performance is no guarantee of future results. All right. I want to give you a heads up on the workshops that are coming up and market drive events. If you can get to any of these, you'll be happy that you did. We've got Dallas, September 20th, Chicago, October 4th. Those are market drive events, which are one-day events. And extra personnel come in for those particular market drive events. And what's really cool about them is they weave in current things going on out in our trading world, out in our economy, and how that lends to different strategies. So it's really insightful that way. You get a whole day of that type of thinking. And then in Orlando, we'll do 2 days. First day will be technical analysis, and then the next day will be option strategies in Orlando. And who doesn't want to go to Orlando in October? It's probably a pretty nice place to be there. All right. Now, typically, we'll take a look at market conditions. We'll do that briefly here today. We'll talk about what option strategies might benefit in the current market conditions. And like I said, we're going to do some comparing and some contrasting here today as we look at a lot of examples. And of course, we always want to follow up on some of our active trades, what's going on with them. That's half the battle. Yeah, I know some of you are putting on these example trades in your own paper money account so you can follow them and track it. That's really helpful to do, because then as you have questions, you can bring those questions to our session and say, Friday the stock was looking like this, and this is what I thought, and this is, what the situation was that I discovered. Okay, you can share that type of experience with us here. Let's go to this next slide too, because this talks about the different strategies we typically consider in this class. Once in a while, we'll throw in something new, but for the most part, we stick with these strategies. While we've had bullish market conditions, we have done a lot of these bullish strategies. A couple of weeks ago, it wasn't in this class though, so never mind. I was going to say we did some bearish strategies, but I think we only did one bearish trade, and it's been a couple of weeks ago. Sometimes we'll do some neutral strategies if we see ourselves in market conditions that are just kind of range bound and stuck. Then we don't have a big expectation for movement. We might explore something of those strategies. In fact, one of the strategies we're going to follow up on today was a calendar spread that we put on last week. All right, let's hop over to Thinkorswim here. And let's see. I can get to it a little bit shorter way. There we go. All right, I have our current positions sitting here. We're not going to look at them quite yet, but we're going to start out with the volatility index. Now, Friday and Thursday, we had kind of a spike in volatility. The markets were pulling back, not dreadfully so, but enough that the volatility index spiked here, right? It's the put call ratio, and when we have more put buying than call buying, that lets us know traders are trying to possibly maybe buy some hedging type strategies, right? Buy long puts or something like that to hedge their position. When these things get really high, that means, man, we're seeing a lot more put buying, and they could be for a number of reasons. They could be for hedging or trying to make profits in a downtrending market. So yesterday it dropped quite a bit. Today it's been a little bit all over the place. Earlier today we've been down. There was a little trying to get back. The market came down off the lows that it had. So there's just kind of this fight all day long. So volatility is still out there. It's not incredibly high, but we are seeing a little bit of it as we're seeing a little bit of weakness in the markets. Now the SPX, we'll pull that up here next. Where did it end today? We have this bounce yesterday off the 30 moving average. That's what my red line is. And today, what kind of a candle pattern do we have here? Do you recognize this candle pattern? We have basically a bearish candle going well into the body of a bullish candle. Okay. Many times we'll see that upper resistance. This one isn't quite at that level of resistance, but maybe the 10 is acting as resistance. Anyway, if you know that candle, hopefully you just spit it out and told your dog or your cat. Yeah, that looks like something we might call a dark cloud cover. And a dark cloud cover means kind of the imagery there is, man, it's going to rain on the bullish parade, right? If those dark clouds develop into a rainstorm or something, yeah, that might put a damper on things. What does the NDX look like? It ended up similar here at the end of the day. On the dark cloud cover, what we're looking for is for the body of the bearish candle or today's candle to be well within the body of this candle. This one's even deeper into the body. And so we'd probably say, okay, that has a little bit more bearish connotation there on the NDX. The SPX was still well into the body of the bullish candle here. Yeah, David knew that was a dark cloud cover. Excellent. And the Russell 2000, we'll take a quick look at it. What did it do today? Look at that. It ended up on a positive here. We don't look at the Russell 2000 or small cap stocks a whole lot in this class because we're looking for a lot of liquidity. And many times those smaller cap stocks just don't have the kind of liquidity that we need for option strategy. So we don't focus on it too much, but this could be something for us to keep our eye on. The fact that it is positive today. And let's see, the Dow Jones and the Russell 2000, it's been interesting. Those large cap stocks and those small cap stocks have been trading kind of similar with each other. Looks like the Dow tried to eke out a gain, but it was down just 0.14%, so not that much. At one point in the day, that body was well within the body of this bullish candle here. By the end of the day, it kind of pulled out of it. So it wasn't closing near its lows, so maybe we're seeing maybe a little bit of strength move in. We'll see what tomorrow brings. Now, one of the things I wanted to do today is I wanted us to take a look at a stock. We're going to use Boeing as our example stock today. And what I wanted to do is determine and talk about some pros and some cons of using possible strategies for the trade that for this stock. We're going to say it's bullish in nature. Looks like it's bouncing up here off its 30-day moving average. Boeing, was so troubled several months ago, finally working its way out of it. Put in here last week a new 50-day, year high, 52 2-week high type of thing. And so it's definitely recovered quite a bit. So even though the short-term trend with the 10-day is moving down here a little bit, that intermediate trend is strongly moving up. Okay. So this could be for some people an entry because it has a bullish, kind of a bullish candle here today, bouncing off a moving average in a market that was a little bit pulling to the bearish side today. Earnings are out of the way. In fact, that's what caused this big, enormous range that day. They announced their earnings, they gapped up, they ran high, and then they kind of sold off as the day went on. But it looks like it's recovering here, just a few days after that earnings announcement. Now we're going to go over here to the trade tab. Boeing traded 5.4 million shares today, so it's a pretty liquid stock. That's good. We love that. When we're trading, looking for option trades, right? We want to work with where there's a lot of activity. Now, some stocks will have a lot of activity, but they might not have necessarily weekly options available. There's a lot that have really wide, a lot of open interest in the weekly options, which is nice because that gives us some different options in terms of, what time frame might we want to use? What strike price might we want to use? So our first trade that we're going to look at here today is we're going to look at the September 5 expiration date. They have 31 days before they expire. Many traders like to use a window from 20 to 50 days worth of time. Maybe it goes 20 to 40, but then sometimes we have to go out a little bit further. And so it's kind of nice because this has several choices there. 24 days to expiration, 31, 38, 45. Okay, so there's a lot of choices here. We're going to open up the September 5s here. And I want you to notice there's some, I'm going to say decent open interest in some of these strike prices. Some of them maybe not so much, right? 37 contracts, 6 contracts here. But these that are closer to at the money, where we've got, several hundred, those seem to be have enough open interest that we could work with here. Now, the first trade that we're going to construct here, we're going to do a 215, actually, we're going to go a 220, 215 put vertical. We've got a 37 delta here. I'm going to put my mouse on this one. We're going to say sell vertical, and we'll come back up here. We've got a 37 delta, so that can be a range that people like to target for helping them choose the strike price, right? 37 delta. Some people might use a 20-something delta. The trade-off, and we're going to put some trades together here, is higher probability of success or lower probability of success. Okay, so this one has a 60% chance or probability of expiring out of the money, and that's my probability column that I have selected there. Is I move my mouse just a little bit, you can see that it balloons out there and says out of the money. Okay, well, that means a 60% probability that we could be right in the trade. We put this one on. Okay, now a $1.86 credit. What do you think about that? I'm going to say that is pretty beefy, pretty juicy. Okay, how juicy is it? Let's just run a calculation here. We'll say 5 minus 1.86. 186 is going to be our maximum theoretical gain. And 314 is going to be our maximum theoretical loss. Now, I'm just going to maybe delete these numbers here and use this space. So we've got 186, and then we've got 314. If we divide the max gain by the max loss, it's going to give us a percentage. We're going to see what that percentage is. I'm saying based on my eyeballs that it's kind of juicy. So 1.86 divided by, that ended up 3.14, is about a 59% return. Now, I'm going to say that's in a very beefy, juicy area, okay? Which is kind of nice because it has a 60% plus chance of expiring out of the money. Okay, we're going to call this trade A. Next trade we're going to do is, well, what if we want to maybe have a higher probability, but maybe higher probability, but a lower reward. Okay. In this case, we're going to do the 215, 210. Now notice we're going to sell the 215. It's got a 27 delta. So that's a little bit lower than the atypical range some traders might look for, but look at the percentage here. It has a 70% probability of expiring and out of the money. That's a whole 10% more than the first trade we put together here. Scott wonders if that 220 spread is a little wide. You know, it's interesting, Scott. I appreciate you pointing that out. Throughout the day, this afternoon, actually, as I was looking at these options for what we're going to look at here today, I was noticing a little bit of a wide spread there, but I wasn't really sure why. And then they would collapse back up. So like one time, one of the options had like a $3 wide spread. I was like, that's not normal. And then, a couple minutes later, it tightened right back up. Okay, so maybe where it's ending right now, 210 by $6, yeah, that is a little bit wide. We're going to be looking, if somebody were doing this, we're going to be looking for the midpoint area here. But you're right, if the market were engaged and this were the spread, you might go, let's think about this. Okay, so I do appreciate you lining that up. Once the market closes, all these orders come in, right? And the bid and the ask prices continually just kind of change as those orders come in. And so that's why we get these, what I think I'm going to call artificial spreads, is due to that. Okay. Don't they whiten up in after hours a little in general? Yeah. Just, kind of like what we just talked through. And then during the day, they collapse back up. So my expectation, it traded 4 million shares today. My expectation is it's going to tighten right up. If there were some volatility, if there were some news events that maybe were driving the stock majorly up or majorly down, especially majorly down, then it might be normal to see that wide of a spread. But if the stock's in sync, there's no major news driving it, then typically it is kind of in an acceptable range. But let's put together here 215, 210. And we're going to sell that vertical. Now that one's quite a bit less. Okay, it's $5 further out of the money. So we'd want the stock to stay above 215 instead of 220. That gives it a little bit more leeway, right? 215's down here. 220 is right there. Both of them have some decent, at least $4, almost $5 of leeway, and this one down here about almost $9 of leeway. So let's give a value to that particular return. This one turned out to be 59%. Okay, this one, let's put in our numbers. We got 0.98 as our max theoretical gain. Take 5 minus that. 4.02 is going to be our max theoretical loss. And let's go see what that percentage gives us. Some of you might have an idea in your head. 4.02 there. It's going to be 24%. Okay. I think part of that is the wide spread. When I was testing this out earlier, the number that I came back with here was actually, it was about a 32% return, not a 24% return. So it is being a little bit artificially wide on us. Okay. Now, suppose, let me see here on this one, 163.40. Yeah, the credit on this one had come in significantly higher than what it's showing here, which is interesting. Okay, but it is what it is. So this first trade we're going to call trade A, and the second trade we're going to call trade B. Okay, so I'm just going to type in here A for the top one, be for the bottom one. Okay. In terms of this particular spread, and we'll just take the numbers like they are, does one of these feel more suitable to you than the other? If so, go ahead, chat that in, okay? And let me know. I kind of wish our class was held during market hours so that we could have a little bit more accurate reflection of what those prices were, because half an hour ago, they were quite a bit different than that. Actually, in both the spreads. Both of them were different than what they are now. Like I said, on this bottom spread, instead of being 24%, it was about 32%, which is significant. I think that's significantly different. All right, which one are you more comfortable with? And again, Scott may say one particular one is more comfortable to him. John may say something totally different. Now, John says, how does the market maker move play into this? Oh, you haven't heard any of our discussions on that, John? We can talk about that. Okay. As your answers come in, because I know there's a little bit of a delay when I ask you the question and you hear it and then you get a chance to respond. The one that makes more sense to you, we're seeing Stephanie's a B, Sharon's a B. The Lola says the 220 strike has the 50 moving average above, so I'd be more comfortable with that trade. So the 220 strike is going to be our top trade that we're selling 220. And I don't have, on my chart, I don't have a 50, I have a 30. So what you're saying basically is that it's above the 50 as well. Okay, so it's above the 50, it's also above the 30. 30 being maybe a little bit more, kind of a little bit more aggressive for an intermediate trend. All right, some people use 30, some use 40, some use 50, so 50 is going to encompass basically 20 more days than a 30 is. So yeah, it might not be quite as reactive to things, okay? Let's go back here. John says, I'd like to see the chart, but it seems that A is too tight. Could be. All right, Cornelius is an A, David's an A. You guys are split here, okay? That is just fine. It's just fine that you're split here, because one might feel more comfortable to you than the other. Something I wanted to do is I actually want to compare some similar trades. Now, I can't put both of these trades in and let us track it because this 215 put that's positive would cancel out this 215 put that's negative. They would cancel each other out, and we'd end up with just 220 and 210 sitting out there, okay? Assuming we did the same number of contracts on each one. So I want you to look at something here with me. I'm going to change the date here from September 5th, and we're going to do it on this one that I'm not liking quite as well, okay? We're going to change it to September 19, but we're going to use the same strikes. We're still going to go 215, start 215 and 210. And you'll see there's a lot more open interest and the spreads are significantly tighter. And this is what I was seeing before the market closed is September options, maybe not quite this tight. They were maybe more around 20 cents rather than 15. But what if we do this? What if we change this to the 19th of September, and then we see what that gives us? Well, $1.25, that's significantly better than 98 cents, isn't it? In fact, if we said, all right, $1.25 divided by the max theoretical loss of 375, that gives us about a 33% return, okay? Some of you might feel a little bit more comfortable just going that direction altogether, okay? Tree says, does Thinkorswim let you buy and sell the same strike? Well, it's a little tricky because they overlap each other, okay? And so they end up canceling each other out. It's called an embedded terminology for it is embedded within another strike. And so what we're going to do is, guess what? We're going to do trade A with September 5th. We're going to do trade B with September 19th. What would be the advantage now, say, of this trade going out a little bit further in time? It's got 45 days. What would be the pros and the cons of, say, this one, which is now trade B because I changed trade B, over trade A? Think about that. Answer that to yourself. Think about, okay, what would the pros and the cons be? A con might be that it's going to take longer to realize the profit because it's 45 days instead of 31 days. Okay, so some might not like that so well. It means our theta decay, our theta is probably going to be a little bit smaller than what it is on the trade that's 31 days out. Maybe an advantage would be that there's more open interest here, so maybe you feel a little bit more comfortable with the bid-ask spread, right? If it's 15 cents instead of what we were seeing that was fairly wide, right? 40, I think it was 40 or 45 cents. Yeah, some might feel a little bit more comfortable with that. Yeah, Cameron's got an answer there for you. You know, you have to use different Thinkorswim accounts, or, you know, I could change this one up here, which is my basically my margin account, and change it to a different account, which would be like our IRA. We really don't have any trades going on there, so we're going to work it this way. Can you think of anything else? Okay, Lola says, you know, there's more time for the trade to work if it goes against you. Yeah, that could be one possibility. If it still meets your return objectives, then yeah, you do have a little bit more time for it to work out. Now, this looks like it's going to be about a 33% return, and I'm just going to say here, 2- for the second trade is 33%. Okay. Now, between the two, I hope that you have chosen for yourself which one you feel like, oh, yeah, I would want that one. Okay. And it's going to be something more aggressive with less time to have the trade go to fruition, 31 days, and a significantly higher return of 59%. I'm going to say that's beefy, that's healthy, that's juicy. But the trade-off is the probability is not as high. Now, what I didn't look at here yet, with changing the months here on this 215, selling the 215, is it's a 66% chance. Okay, remember in the one we did with the September 5s, it was a I forgot what the percent was. It was I'm gonna have to go up here and look at it real quick. I think it was, yeah, it was 7. Selling that. Well, we went to the 210 here. 210 on this one would be 78%. Okay. That makes sense? You have a clear feeling for yourself, because I'm kind of giving you aggressive, bigger return, more conservative, more time for the trade to play out, and a lower probability that you're okay with the trade-off of that. Okay. David says, you know, rate of return per day for the B is better with the 29th of August. So going less time, which is even shorter than our September 5 time frame. But there could be actually a little bit more open interest out there, yeah. So Lola says, I don't usually define credit spreads with 59% return. Is that typical? And that's why I'm saying no, it's not typical. It is unusual. And I do think part of it is this artificial spread that we're seeing here at the end of the day, because the numbers were not that high 15 minutes before the market closed. In fact, this spread that right now is coming out at 59%, for me, it was 47%. So that's 15% lower. Okay, so that might be more like Oh, okay. A little bit extra from maybe something that's normal to you if you normally try to target a 30 something. Okay. We're going to put these in. We're going to put both of them in. And I want you to know these are for observation and comparison. Normally, you're not going to do both. Okay, you really aren't going to want to do both. So we're going to hit confirm and send. We're going to send this to our option strategies class and put them in that bucket. And they're not going to overlap each other now because I changed the months there. Okay. So both of those were credit spreads. Now, what if we were to do a debit spread on this? Okay, so we're going to go back here. We're going to open up the one thing I needed to answer your question here about the market maker move. Now that we've got those trades in, let's do it. The market maker move is right here. And it's saying $2.02. And not all stocks show a market maker move. And usually it's just for some event that might be upcoming. So a lot of times that means earnings. Well, the earnings is already out of the way here. That happened on the 29th, so last week. So I'm not really sure what the event is that's being priced in, but it's really a small move. Okay, it is only plus or minus $2. And if we come out here and say, okay, the weeklies by the end of the week, we're looking for the stock to move $5.48 by Friday. This makes me think that this was possibly just a today only move. Okay. Usually when stocks are going into earnings, we'll see much bigger market maker moves put in here to account for the expectation of movement. And so, yeah, if we were to pull something up that's going to announce earnings tomorrow or sometime this week, likely we're going to see this be significantly higher. Okay, so hopefully I hope that helps you. I can't remember who asked that question in terms of how do you utilize that. Now, we have used it sometimes in this class where we said, hey, the market maker move is expected to be plus or minus $15, and we look at some different trades based on that. Okay. All right, Cameron may have given you an answer on that as well. Okay, so the next one I wanted to do here, we're going to go back to September 5, and we're going to look at, it does have 31 days, and we are going to look at a debit spread. And we can construct debit spreads conservatively and aggressively as well. Many times we'll start with our at the money option, which in this case is going to be 225. And many cases we'll start at 225 and we'll say buy the vertical. And many times we're hoping to get maybe 100% return. We're hoping to get, by doing something at the money, we're hoping to risk, say, $1.90 to gain, say, $1.90. If we were to divide this $5 wide spread in half, that would be $2.50. And so we might be trying to target $2.50, risking $2.50 to make $2.50. Well, this one is actually quite a bit different, isn't it? This one actually is going to be what? 190 and 360. Is it going to be 360? I better do my math real quick. No, it's going to be 310. Okay. In this one, so let me just put those numbers in here. Our max theoretical loss on this, because it's a debit, not a credit, is 190. 5 minus 190 is going to be 310. So we would be risking 190 to make 310. But instead of just staying above a certain point like we did on the credit spreads, the stock needs to move. How far does it need to move? Well, in this case, the long strike or the short strike leg is 230, so we need it to move beyond 224.86. We want it to go up to say 230, and as we look at that on the chart, where is 230? Okay, 230 is my mouse is pretty close to it. I'm going to stop it when it's really close. It's about that far. So it's not like it's just barely above its head. It does actually have to move quite a bit. The payoff, however, is very juicy. Once again, let's run the numbers on it. We have to gain 310, our max theoretical gain, divided by 1.9, our max theoretical loss. Whoa, baby. 163%. Now, I'm going to say that's healthy and a half, okay? Whereas many traders try to target risking 250 to gain 250 in a $5 wide spread. Okay, what if we change that? Let's change this to our blast odds so we can look at two sitting up there together. And what if we said, okay, fine, let's do, instead of selling or buying the 225, let's buy the 230. We'll buy this vertical and we'll sell the next strike out of the money. And in this case, oh, I went the wrong direction that I wanted to go. Sorry, let me delete this. I want to be more conservative. Okay, this one was aggressive. Sorry, I needed to go this direction, 220, because that would be $5-ish in the money. We're going to say buy vertical. And now it's kind of tipped the other way. Okay, now we're risking 363 to gain what? 5 minus 363 is going to be what? $1.70. That should be $1.70. I think I missed a digit there, didn't I? Let's go 5 minus 3.63. Okay, $1.37 here. Okay, so down here, our potential risk is 3.63. Our potential max gain, and I should put ML here, is going to be 137 max gain. So it's kind of like tipped the scale the opposite direction. Let's see what our return is in this case. If we're willing to risk, let's see, our max theoretical gain is only 137. Divide that by 3.63. That's about a 37% return. Now you might look at both of those and go, I don't know that I like either of those. That would be okay. You don't have to, nobody's going to paint you in the corner and say you've got to do this, right? That's not going to happen. But you might feel more comfortable with one over the other. Now, I'm just going to run this number one more time just to make sure I didn't fat finger anything. 137 divided by 3.63. Okay, I didn't fat finger. I just want to make sure. Okay, now tell yourself which of these, if this is trade C and this is trade D, which one do you like better? Trade C is the top one. Trade D is the bottom one. Okay, which one do you like better for you personally? If you want to say neither of them, you could just say neither of them too. You could say 0, Connie. I don't like any of them. Okay. The one thing I was going to do, and I'm going to kind of do this because in the interest of time, is that we would have the same problem here of putting in both of these trades to do a compare and contrast, because our 225 strike prices, they would be the ones overlapping each other. Okay. So a lot of you are saying, okay, D is much too puny. If we're going to be a more aggressive trade, you're liking C better. Okay. So that's good to know. That's good to know about yourself. Now, John likes D better. I think Sharon said 0. Sharon does not like either of these, which is just fine. I told you that could be the case, right? David's a little bit more comfortable with these. So one is, I'm going to say, very aggressive and a high return. The other one is much more conservative with a lower return. And it might just depend on your personality, which one you feel more like. In this case, with the 225, do we need it to move a lot? We really don't. We need it to move 14 cents. Okay, that's all we're asking it to move is 14 cents. Versus this first one, it's going to be $5.14 that we need it to move and hopefully go beyond. Okay, because I don't want those to offset each other, we're going to do something here, and I'm going to do the same thing here with this spread. Actually, I'm going to do it with the one that's, yeah, I'm going to do it with this spread because I think it's the least desirable according to your voting. And so I'm going to change that to be the 19th. It still is a big debit. You're still bringing in a smaller max. You're risking more here than what you bring in, but it's a little bit nicer ratio. Okay, so we're going to put these in and we're going to let these play out. I'm going to watch them, and we're going to go back and revisit this. But I hope at this point you're like, okay, on the credit spreads, I like this better. On the debit spreads, I think I like this other better. Okay, let me send both of those off, and we'll put them in our option strategies bucket. Now, I do want to review a couple of trades with you, and we're going to do this quite quickly. All right, I might not review all the numbers with you. First one, we're going to do Kroger. We got in Kroger a couple this day, so a couple weeks ago on the 23rd, and we're getting in on a nice little bounce here. We did a trade here. We did a short put vertical for a credit spread, and it went. This is what's so interesting about this. It was a short put vertical, so we need it to go up, 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 up. What did it do? It came down. It went below our strike price, but today as it ran back well, yes, 2 days ago it closed above it, okay? But now it's going past it here. So we've had quite a bit of time decay. It went ahead and hit our target. So this is one of those trades where it didn't do exactly what we thought, but it still worked out. We ended up with a 19-cent credit after we subtract out what we bought it back, what we had to buy it back for. And so it ended up being about a 285 gain. Micron, I do want to talk about. Micron, we did you can see right here, it was a short call vertical. We got in here because we looked at it this way and it was just bouncing down. These moving averages were heading down. It was a lower low and a lower high. And shortly after we got in, kind of went sideways for a bit, but then it had this bullish day. On this bullish candle, it ended very strong, and it looked like, geez, it's making a little bit of a higher high here. This could be the beginning of a trend change. Okay, so I went down, I closed out of the trade. We lost money on that one. We lost about 280 in it, which was a partial loss, nothing close to a max loss. But what if we had been a little bit more patient? Where would we stand today? Well, we can see the price is significantly lower than where it is here. And if I come over to the trade tab here, not the trade tab, the monitor account position for Micron, if I come out here and say, do a duplicate order here and see what the value, oh, I did it on the wrong one. Do a duplicate order on our credit spread, and we're going to create an opposite order on it. Actually, do you know what? I'm going to use this one. I will use this one. Create duplicate order. Basically, this is the order we put in where we bought it back. We had to buy it back for 87 cents. If we were to do it today, guess what? 42 cents. We would have been upside right on this trade. So that's why you have to be convinced that the stock is changing on you. Perhaps I got out a little too early. I had a technical reason for it. But maybe if we had exercised a little bit more patience in it, we could still be in the trade and we'd actually be profitable on it right now. I think it's important to go through trades that work out as well as trades that don't work out so that you can see that. Now, my time is up, you guys. So a couple of asks of you. Make sure you're a subscriber to our Trader Talks channel so you can find our content. If you found this helpful today, and I hope you did, and you feel better about, I know which lane I want to be in, more conservative, more aggressive, whether it's a put spread or a long call vertical spread on a bullish trade. So if this is helpful, hit the like button. We appreciate your feedback here. Follow Cameron and I on X. Cameron, thanks for helping us out today. We'll see you next week as we follow up on these trades. Bye-bye.